flow to the firm by some discount rate. And then you have to subtract the value of that to get a value of stock. Okay. So the logics of using the operating cash flow or the free cash flow to the firm is not important. So some might say operating cash flow is the exact measure of the cash flows to the firm. Or some others may say free cash flow is the more exact measurement of the cash to the value of the firm. So it's not important here. This is the sum. Yeah, let me explain that. Free cash flow is that a company, okay, free cash flow to the firm is the cash flow that company generates from its normal business operation after subtracting operating expenses and before interest payments and after subtracting any money spent on capital expenditures, or we call capex. So and operating cash flow, on the other hand, say free cash flow is the net operating profit after tax. So it's called earnings before interest and taxes. So this is the operating profit times 1 minus t after tax. So this is net operating profit after tax plus a non-cash expenses such as depreciation and appreciation and increase in net working capital and minus capital expenditure, capex. So this is not really important. I will not ask you to estimate the free cash flow or the operating cash flows. You may measure this free cash flow and operating cash flow in accounting class. This is in finance class, so measuring this free cash flow or operating cash flow is not important. The more important thing is that you use this earning measure and to value an asset. Okay. Anyway, the net working capital here is the measure of firm's liquidity that helps determine whether a company can pay off its current liability. So we measure net working capital as current asset minus current liability. And this is not important. I'm just explaining it. I will not ask you on the exam, okay? So this is the accounting concept. So difference between free cash flow to the firm and the operating cash flow is that the operating cash flow is that cash that generated from the business by solely on its business operations. So operating cash flow shows whether a company generates enough cash to run its business. So operating cash flow is more related with its business operations. So cash from the operations. And while the free cash flow to the firm considers operating business operations plus non-operating business. Okay, so total cash. This is a total cash concept. And operating cash flow considers only those cash flows generated by normal business operations. And anyway, I'm just introducing this concept, and this is not important in our class. Okay, so value of the firm J is equal to the sum of its future operating cash flows or free cash flow to the firm divided by some discount rate. Since these two cash flows are available both to bondholders and stockholders. right? So from this operating cash flow or free cash flow to the firm, we pay interest payments to bondholders and we pay out dividends to stockholders. So this cash flow, so both bondholders and stockholders are owner of these cash flows. Okay, while net, say in accounting income statement, the net income is only distributable or available to stockholders, while the operating profit called earnings before interest taxes is available to bondholders and stockholders. So this operating cash flow and the free cash flow is the operating concept, which is available to both bondholders and stockholders. So when we discount this cash flow measures, we have to use a weighted average cost of capital to discount this measure. Okay. So recall the dividend discount model. The discount rate was the cost of equity, because the dividend was only available to the equity, the stockholder. On the contrary, this operating cash flow and the free cash flow to the firm is available both to bond and stockholders. So we have to use a cost of capital, not cost of equity nor cost of debt. We have to use cost of capital as a discount rate. Okay, so this is the weighted average cost of capital. And similar to the dividend discount model, the discounted cash flow, the DCF, discounted cash flow model can be used to estimate an infinite period of time where growth has matured to a stable rate. So if we assume this operating cash flow or free cash flow to the firm will grow at some constant growth rate, we can apply the constant discount model, say operating cash flow at time 1 or free cash flow to the firm at time 1 divided by K minus G, which is the weighted average cost of capital is equal to the discount rate. So since the value of the firm, is value of equity plus value of debt. Okay, in the financial statement, the statement of financial position, the firm's total asset is consisted of debt or liability plus equity or stock, right? So the asset is equal to debt plus stock, equity, owner's equity. So the value of the firm, the market value of the firm, so this is the asset. So market value of the firm is the market value of equity and plus market value of debt. So if we discount operating cash flow and the free cash flow to the firm, these cash flows are available to both bondholders and stockholders. So if we discount these cash flow measures, we can get the value of the cash flow available to both equity holders and debt holders, which is the value of this asset. So if we discount this as 1 plus weighted average cost of capital, we can get the value of cash available to equity and debt. So we call it the value of the firm. So the value of the firm is value of equity plus value of debt. So using the discounted cash flow model, we estimate the value of the firm. But our purpose is not to derive the firm value. We're focusing on the value of equity. So after estimating the value of the firm, value of the J or value of the firm, you can get the value of equity, value of stock value, by subtracting the value of debt. Okay. So since value of the firm is equal to equity plus debt, you can estimate the value of equity by subtracting the value of debt from the value of the firm. And you can get this value from the financial statement. A statement of financial position. Okay. So this is the total liability. Ability. You can get this value either from the statement of financial position at the book concept, and you can get the market value of that by valuing this total liabilities, applying those bond valuation models. Anyway, this is not important. The important thing is that using the discounted cash flow model, the DCF model, you will get the value of the firm. After you getting estimating the value of the firm, you can estimate the value of equity by subtracting the value of debt. Okay. So assuming several different rates of growth rate for operating cash flow or free cash flow to the firm, these estimates can be divided into stages with the supernormal dividend growth models. So you may estimate the rate of growth and the duration of growth for each period. So you can apply two-stage discounted cash flow model. Okay, so you can apply this DCF with two stages. Okay, there are another cash flow measure. We call it free cash flows to equity. While operating cash flows and free cash flow to the firm is the cash available to both bondholders and stockholders, this free cash flow to equity is the cash that only available to stockholders. So free cash flow to equity are derived after operating cash flows have been adjusted for debt payments. So this is the cash flow after debt payments. So if you discount this cash flow measure, the cash flow to the equity, you may not use the cost of capital. Rather, you have to use a cost of equity because you're discounting the cash flow to equity holder. Okay. So like this, cash flow to equity. So you can also use operating cash flows or free cash flow to the firm, or you can estimate the value of stock using free cash flow to equity. So which one of these you may either any of this, but some might prefer operating cash flow, or some of you will prefer free cash flow to the firm or to the equity. So this is some kind of accounting concept. Which measurement really exactly reflect firm's cash? Is this firm's real cash is from operations, or operations from firm, or these two are almost similar, free cash flow to the firm and free cash flow to the equity. So this free cash flow to the firm start with the operating profit called net operating profit